Let's check in on your markets picture now with the US still asleep. Of course, we start with the EU. And London's FTSE has seen a fresh peak after signs of cooling inflation bolstered expectations of a Bank of England rate cut as soon as next month, while miners rallied on surging metal prices, quite the same as us. Looking at the FTSE now, down though 0.54%, so a change from earlier on. The CAC 40 losing 0.64% for the DAX there, down 0.68%. So those are the European markets. They're down at the moment. But for the JSE, the all share has been mostly flat today. Now, Sasol has been up around 12%. That's one of the big stories from today. Gains also for Mondi, Exxaro and Premier as well. Looking at the all shares, lost quite a bit in the last hour, down 0.44%. Resources 10 rather, down 1.26%. Financial 15 losing earlier on, up now 0.12%. The industrials also relatively flat today, but down now 0.07%. Well, joining us with his take on market moving activity at midday and how it's impacting on trade is Kyle Burgess from Nedbank Private Wealth. Hi, Kyle. Good to chat to you once again on Business Lunch. Let's start with the United States, those US Fed minutes. Looking at interest rates, I mean, the US at the moment kind of in no man's land when it comes to interest rates. The US Fed undecided, it appears.
Yeah, how's it, Drake? Good to see you again. Thanks for having me on the show. And I mean, I don't think there was many surprises in the Fed minutes last night, and you would have gauged that from the reaction through equities, treasuries, etc. But yeah, Fed's still concerned about inflation not necessarily falling quickly enough. So some sort of broad concern there. But still, the overall message is that there's still the expectation for 2 rate cuts this year, and perhaps one in the early part of 2027. But again, that's all data dependent. But I would note that there is some, I guess, upside risk for inflation, particularly given valuations for tech counter than the US market in general. So I think that's probably one of the single biggest concerns for market participants at the moment, if there is some sort of surprise inflation that does seem to come through. But yeah, we'll wait and see.
Yeah, wait and see what happens. All right, back home, Kumba Iron Ore, and you would have heard in the news bulletin there, doing really well. A nice uptick for them.
Yeah, no, a solid set of numbers. I think, again, if you had to have a look at their production numbers, like reasonably okay, up I think about 1%. Iron ore prices have been fairly steady over the last 12 months over that period. So yeah, certainly would have been comfortable with that set of results. I think, from a portfolio perspective, we're always quite concerned around just having, one specific or exposure to one specific commodity, like Kumba as an example.
Sure, we're starting to lose you there a little bit, Kyle, talking about Kumba Iron Ore. Let's see if we can get you back on as well. Talking about Goldfields as well. Now, Goldfields has been the big story. It really has been. And we'll get back to Kyle in a second. Goldfields has been really big, and I'll be chatting to the CEO a little bit later on, but also asking the questions as well. What happens when we get to a down period? Now, gold today at about $5,019, so that's coming up shortly. Kyle, we're back with you talking about Kumba Iron Ore. I've jumped forward now to Goldfields as well. A great set of numbers, but I mean, gold's the place to be at the moment.
Yeah, it seems like it. Gold and precious metals miners had a phenomenal 12 months, and certainly, buoyed the JSE very nicely. In fact, probably over the last 18 months. But again, I think if you look at those gold miners, valuation sky high at the moment. The gold price is sky high, and you could make the argument that there's very good reason for that, given potentially inflation expectations, just general uncertainty, geopolitical risks, etc., etc. But I think if you have a longer look at the price of gold and how it reacts, typically you see these sort of strong peaks in the gold price. It makes us a little bit nervous around taking positions in gold or gold equities. So yeah, certainly not for the faint of heart.
Yeah, absolutely. The same with DRD earlier on this week. Okay, I want to go back to the US now, NVIDIA, and going in with Meta. And this is stop those jitters when it comes to AI. What's your take on this?
Yeah, so I mean, I think broadly speaking, if you look at these hyperscalers and the amount of money that's been spent on compute power, just as a percentage of their market caps is significant, between sort of 5 and 15%, depending who you look at. I think Meta is probably on the higher end of that, probably closer to about 10%. But again, they're NVIDIA's number one customer. And have been for some time. So, a large part of that is obviously securing, capacity for themselves, so a compute capacity. There's, massive interest in these chips from, a broad array of competitors who've got a lot of money to burn on them. So it's about securing that supply for, and they are committing, I think, $15 or $20 billion just in the next 12 months. To chips. So, yeah, certainly a positive deal for them. But again, on both sides of that, they'd be wanting to secure their access to those chips. And again, I think what market participants will be focused on is the return on investment on that, on that AI sort of infrastructure rollout spend. And I think that's what investors need to keep in mind.
Yeah, but they need to keep that in mind. It's such a fragile market at the moment. Last week, we're talking about these jitters and people not sure and Apple taking massive losses. This week now, all of a sudden, it's a different picture.
Yeah, well, I don't know. I think if you take the noise out of it, and that's what's difficult about investing in a market like this. Generally speaking, a lot of markets have done particularly well. We're talking about the UK being at record highs. Europe has done well, particularly in relation to the US. You've got US tech assets, particularly, which have done really nicely. We're looking at sort of peak valuations there. So it's not easy to allocate capital. And again, there are going to be jitters at this point in the cycle, particularly when there's perhaps a change in expectations around interest rates, what they may do, inflation, what that may do. And, that's why you've seen such a strong focus on the Fed at the moment, and, potentially the Fed's successor. But just a taste of, I guess, why the market is fragile at these levels.
Yeah. Right. The US and Japan clubbing together with oil and gas. And, this is this whole thing about going against China. It looks like certain countries are going into certain clubs because it's the United States and friends versus the rest. I mean, what are you seeing at the moment for markets?
Yeah, so I mean, the US and Japan are allies that go back, a long time. And, I think the primary concern here is securing supply chains for critical minerals, given the rollout of AI and the big tech spend that you are seeing on data centers, et cetera. These critical minerals, between 60 and 90% of them, depending on what you look at, are controlled by China. So again, you want to sort of secure supply outside of China. Also diversify where, your supply chains. So that's a big driving or initiative for the Japanese, is to essentially diversify their supply as well. So again, it speaks quite nicely to what the US is trying to do to reshore production, for themselves. But again, I think it's certainly a positive from a global perspective.
Yeah, it most certainly is. All right, so hold that thought for a second. Before we move on to your stock pick, let's reflect on the counters that have found favour with your industry peers.
We know the copper story. They're doing great in copper. The demand is absolutely there. They perhaps haven't got as much as they would like. We know they tried to buy Anglo American a couple of years ago for the copper exposure. The iron ore is always something I keep a very close eye on, but iron ore is doing great. They are the low-cost producer in the world. They get tons of it out of the ground. They're really doing very well in that. And they're really good capital allocators.
I looked at Pan Africa results today. I thought it was operationally quite disappointing when it came to the input cost perspective and so forth. But I think guidance looks for me a lot better. Good guidance on the production, probably going to see better margins going forward. And if you look at the average gold price received, it's reaching about 3,400. So if gold prices remain where it is, then it need to go much up higher. Just spot prices prevail, then Pan African is going to still generate a very, very strong set of results going forward.
Right, so Kyle, two very interesting selections there. BHP, that's solid.
Yeah, I think most notably both of those in the resource space gives you an idea of where people's heads are at. But perhaps to start off with BHP, which is something that we hold in client portfolios. And I mentioned it earlier on the show that we've typically held your diversified commodity miners. I think what we like about BHP is obviously their copper exposure. Whether the copper price will stay as elevated as it has been, I'm not too sure. They've also got nice iron ore exposure, and in fact, where they are on the cost curve being very low, positions them, really well for that. So we can certainly get behind that BHP as a stock pick. Again, it's all about valuation, so I think you just need to be careful on that. And then gold miners, we've tended to steer away from them. It's been a difficult trade, I guess, in the last 18 months given their performance. But again, we take the view, we prefer to find other businesses that have decent opportunities I guess on the market for our clients. So it's not something that we've participated in over the past 18 months. So participating now at these levels with gold being over $5,000 would be very difficult. I think even just gold maintaining these current levels will take quite a lot. Again, you probably need quite a strong stomach if you're going to be in gold. It's not something that we hold for clients at the moment.
Yeah, Pan-African, I mean, they've had good numbers this week, not bad as well.
Yeah, not bad. Look, I mean, I actually haven't had a look at them myself, but again, not a business that we're very familiar with or look at or cover, in fact, at the moment.
Okay, all right. We'll leave it there. What's your stock pick at the moment? What are you looking at?
Yeah, it's I guess a bit of a boring one. It's Anheuser-Busch. So they also released results last week. So again, I think with Anheuser, it's important to keep in mind this a sector where people are drinking less, spending less money on alcohol or alcoholic beverages. So that market is in a bit of a structural decline. So you're not going to see 20-30% earnings growth or at least revenue growth. What they are doing is tightly controlling costs, expanding their margins quite nicely. They've got 8 of the top 10 global beer brands. And again, they've diversified quite nicely in each market tailored it towards that specific market, introduced sort of innovative drinks, ready to drink type things, diversified into, in Brazil as an example, their bees platform really operating very nicely. Look, granted, it's not a cheap business to hold. You're paying 21 times earnings. But again, I think a steady compounder over time. And again, if you look at their balance sheet, that de-gearing story has worked out nicely for them and returning more capital to shareholders. So not a blockbuster trade, but certainly a business that we like and hold for our clients.
Yeah, it's a safe one. It really is a safe one. Carl, thank you so much. Good to chat to you once again on Business Lunch. Thank you. That was Carl Burgess from Nedbank Private Wealth.